Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up this hour, retail investors at it again. Once again, bidding up shares of GameStop from a plunge yesterday back to $3.25 a share today. This after Robinhood calls in a $1 billion lifeline following my interview with CEO and co-founder Vlad Tenev. Plus, how will the SEC weigh in? Did any market participants break the law? If collusion happened, will it be punished? We're going to talk to an SEC veteran. And as angry users drop Robinhood, other trading apps seeing a surge. We talked to the CEO of the M1 Finance app, who has strongly disagreed with Robinhood actions and has a new pitch for his platform. All those stories in a moment, but first, another day to watch the markets. I want to get straight to Bloomberg's Ed Ludlow. And Ed, there was activity even overnight while U.S. markets were closed. Walk us through all the action today.
Yeah, it was an ugly day. Stock volatility very high. It's becoming a global story, looking at what happened in equities in Asia and in Europe. And the issue here is the story of the week, Emily. As you know, a frenzy is what they're calling it, of retail traders piling into shorted stocks, going against Wall Street. All the chatter coming from forums like Reddit, as you know, and I know you're going to talk about that a lot later in the show. I mean, the S&P 500 is now negative for the year. It had a pretty poor day, down 2%. Its biggest weekly decline in 3 months, a weekly decline of greater than 3%. And no sector was spared. It was a pretty much sell-off across the board. Technology kind of at the center of that, as you can see. The NASDAQ 100 down by 2%. The NYSE FANG Plus Index, that basket of mega-cap tech stocks, many of which have or will report earnings this week, down 2.5%, and the Philadelphia Semiconductor Index faring a little better, but still down 1.6%. As I said, the story of the week here starts with GameStop, right? We saw retail traders pile back in on Friday. The stock seeing extreme volatility, up 67%. AMC Entertainment, which has been another name discussed on the discussion boards like Reddit, up more than 50%. Tootsie Roll, I never thought I'd be saying this in a markets hit. Tootsie Roll up a modest 2% after the wild swings that stock has seen. And the other big theme on Friday is that we've seen that volatility spill over into cryptocurrencies, Bitcoin being the main example. And who's at the center of that, Emily? None other than Elon Musk, tweeting overnight, #Bitcoin to his many followers. As you can see at the end of that chart towards the right-hand side, that did drive the price up overnight. It's pared back a little bit below 40,000, 34,000 right now, and really it continues to be a story of volatility, even as more Wall Street investors, institutional investors, look at cryptocurrencies like Bitcoin as more mainstream.
You know, Elon Musk doesn't surprise me, but Tootsie Roll does, Ed. Thank you so much for that update and that roundup. So much to digest. I want to continue with our coverage on trading platforms halting buy orders of GameStop, AMC, and others. Yesterday, we had the founder of the popular Reddit forum, Wall Street Bets, Jamie Rogozinski, on Bloomberg. He weighed in on the impact the forum has had on the markets.
My intention when I first started Wall Street Bets, I literally was trying to get myself familiarized with high risk, high return trading potential, playing with stock options specifically. And there was just an absence in the market for a community that could discuss these things, and they could learn, and they could create a community out of it. Did I expect it to turn into this? Absolutely not. I think it's gone well past anything I could have ever imagined. It's quite impressive.
Absolutely fascinating. I'm joined now by former senior counsel at the SEC and current partner at Dorsey Whitney, Tom Gordon. Tom Corman, thank you so much for joining us, Tom. So curious how you weigh in on this. Is anything illegal happening? Did collusion happen? And if so, is it punishable? I mean, tell us, is there something suspect here?
Well, thank you for having me, Emily. I appreciate being here. This is a most unusual situation. These markets are among the most regulated places in the world. There are layers and layers of regulations, yet they still allow for what is now a first-time only event. The shorts in the market, who started this, have done what they're doing now for years. They pick out a company like GameStop, doesn't have very good financials, it's got an out-of-date business model, and they short it. Why? Because they think it's going to fall. The price will fall, they'll make money. But nobody ever fights back with the shorts. This is the first time somebody has fought back. And people supposedly through Robinhood, it's not real clear, but probably through Robinhood, are pushing back at them. It's sort of like David throwing rocks at Goliath, except the real problem for us, not for the SEC, which we'll come back to, but for us is we don't know who David is. David could be bigger than the shorts. He could be a huge, huge hedge fund that's really well funded. Nobody actually knows because there's been no disclosure on that because there doesn't have to be any disclosure right now. So the question is really, in the first instance, who's fighting with who?
Right. So then do you suspect that some of this is institutional money? Because it's a lot of money piling into these stocks. And, you know, I know that there are some of these retail investors out there, some folks on Wall Street Bets who are holding on and could make millions right now, but just want to prove a point. But that said, do you think there's more going on here?
Well, there really could be more going on here because if you think about it, the shorts are probably big institutional players, big hedge funds. They're sophisticated traders. They do this kind of thing all the time. And usually what happens is the company complains, they yell their stock's getting crushed. They're unhappy, understandably so, but they don't really do anything. They maybe file a lawsuit that goes no place, and then that's the end of it. The shorts win, they take their money, they go home. That's not happening this time. But to just suggest that this is all a bunch of 17-year-old kids who have fond memories of GameStop and they're trading through Robinhood because there's no brokerage fees there, which there aren't, because they get paid from order flow. To suggest that this is just a handful of kids like that doesn't really ring true. You have to have lots of trading and lots of money to push this stuff. Now, you could have a conglomeration of thousands of kids who are 17 or other people who have fond memories of this thing, and with a whole pile of a lot of little contributions, sort of like a political campaign where you give $5, they could maybe push back enough on these guys that they start to bail out. And that's the key question now. The SEC clearly knows who these people are because they can go to the brokerage firms, they can go to Robinhood and say, we want the account opening documents. We want to know what accounts are trading that stuff, and it'll tell them. But we don't know that. And that's really sort of the more interesting thing because this doesn't happen to the shorts. Usually, like I said, usually they just go crush the stock. They do what they want. Nobody likes it. Nobody likes the shorts. They think they're bad guys. And so, but it moves on. This is sort of like Twitter where somebody with a big following throws out some statement and then everybody jumps on and fights with them. This is the new technology. This is the new kind of stock market bubble, unlike the ones that you saw maybe in 2000, unlike the ones that you saw even in the market crisis in 2008. This is different because now you got multiple sides, whereas before, all you ever saw was the so-called bad guy, the shorts, and the shorts are just traders like everybody else. They're not really bad guys, but people think about them that way. You just saw them, and you saw them pushing down and making money and leaving home. Now, not so much anymore.
Right. Tom, it sounds like some diligence then on the part of the SEC is needed to find out exactly who these people are. I did speak with the CEO of Robinhood, Vlad Tenev, just after our show yesterday, and he tried to explain why they decided to restrict buying, which is what users are so angry about. Take a listen to his explanation.
It's non-negotiable for us to comply with our financial requirements and our clearinghouse deposits. So we just have to do that. Robinhood has always stood and will continue to stand with the individual investor. We weren't directed by a market maker or any other market participant. This was a technical and operational decision.
Tom, what do you make of Robinhood actions here? Because they're now facing lawsuits. They've got lawmakers on both sides of the aisle calling for an investigation, a hearing, some kind of action. Did Robinhood do anything illegal here or fraudulent?
Probably not. Certainly not by restricting the trading through their brokerage firm. They have obligations to their clients. They have obligations to the market spelled out in all of those customer agreements that allow them to do these sorts of things. And you have to look at exactly how they did it, but presumably they followed their own customer agreements. And there's an overlay of SEC regulations that require them, for example, to have a certain amount of net capital on file. If they don't, the SEC will shut them down. So what you can bet that what the SEC is doing is they're looking at the traders, they're looking at what the shorts are doing, because they usually do. They're clearly looking at what's happening with the traders going through Robinhood, and there's probably other brokerage firms here too. And they're looking at those brokerage firms to make sure that they're in compliance with the net capital rules and the other rules that govern their operations. And if they're not, they'll get shut down.
We're going to be speaking with the CEO of another trading app a bit later in the show. As we were speaking, Tom, a headline just crossed that Silver Lake, the private equity firm, just sold its entire stake in AMC. So certainly there are big players at work here. We're trying to get some more context on that. But Tom Gorman, veteran from the SEC, former senior counsel there and partner at Dorsey and Whitney, thank you so much for joining us, Tom. All right, coming up, more of Bloomberg Technology, another variant of COVID in the U.S. and another vaccination on the way. We're going to bring you the latest on Johnson & Johnson. This is Bloomberg.
Most likely towards the end of February, we'll have an advisory panel pending, of course, decision of the FDA, and then we'll see getting approval, emergency use approval, and then in March, we'll be able to start delivering vaccine.
Johnson & Johnson's CEO, Chief Science Officer there, Paul Stoffels, earlier on Bloomberg Television, he also said the company has started development and production work on a booster to combat the South African variant. Joining us now, Jody Schneider, senior editor with Bloomberg News. Jody, the Johnson & Johnson results are promising. How should the general public be looking at this?
Yeah, I think that's how they should be looking at it, Emily. It's a promising development. Basically, one of the headline numbers is that the vaccine prevented 66% of moderate to severe cases of COVID-19, but even more importantly, it prevented 85% of severe infections and 100% of hospitalizations and deaths in those in the test study. So those numbers are very strong. Anthony Fauci today said if you can prevent severe disease in a high percentage of people, that goes a long way toward ending this pandemic. So even though that 66% number was not as high as in the Moderna or the Pfizer trials, it's a good number, and they are likely to get that emergency use authorization in March, which would then allow them to start sending that vaccine right into arms.
So what are next steps? I mean, is this a vaccine that could be available to the general public, and at what point?
Yeah, so they've said that they could start ramping up as soon as they get that authorization, which could be as soon as March. And we would then be able to see how quickly this could get out the door. The thing that will be really helpful in terms of allowing more people to get the vaccine will be that this will require one dose. J&J is only one dose, whereas Moderna and Pfizer are 2 doses. And as we have seen since the rollout in December, that's really been problematic, getting people there twice. We've had long lines. We've had problems with appointments. We've really seen kind of a rocky rollout. So the more doses that are out there and the less hassle for people in getting that vaccine, the more people that will be able to be immunized, and the sooner you will get to that being able to really reduce not only the severity, but the incidence of these outbreaks.
Meantime, we're still fighting these new variants, and it's unknown how effective the vaccines will be against those. And there's no vaccine for kids yet. Dr. Fauci said today we could have one by late spring or summer. Talk to us about the remaining hurdles towards true herd immunity.
That's right. There's a lot of things that still have to happen. And the variants are abounding. We're seeing this. We've had now news of the South African variant being found in South Carolina and other variants. And Dr. Fauci and others were quite they were acknowledging the fact that we're seeing these and that this is concerning. They seem to think that the vaccines can work against them, but of course there's risks here. And concerns about keeping second doses of the current shots on hand have complicated this push as we seem to get as many people inoculated. And their thinking is that if you can get more of these doses out, that's a powerful new tool and to fight this virus and to get ahead of these variants. That's the whole goal here, as Dr. Fauci and others were telling us today.
All right, Jody, thank you so much for helping us digest the fine print. Jody Schneider, who covers vaccines for Bloomberg, thank you. All right, coming up, cloud software vendor Qualtrics returns to the public market against a volatile backdrop of Reddit threads and Robinhood traders. We're going to bring you a conversation with CEO Zig Serafin and founder Ryan Smith on the heels of their IPO. This is Bloomberg. What a week to return to the public market. Qualtrics, the enterprise software spinoff of SAP, surging in its trading debut yesterday after its IPO exceeded its goal to raise $1.55 billion. I spoke with CEO Zig Serafin and founder Ryan Smith. Take a listen to what they had to say.
This is obviously an incredible day, and it's really just another important milestone in the way that we're growing this company and the way that we continue to lead the experience management market. We have over 3,300 employees today that are working across the globe, helping to deliver breakthrough experiences for, as of today, over 13,000 customers that are working with us today. But with respect to the market, honestly, we've been building this company with a long run view in mind. Ryan can expand on that, but we just don't get caught up in the market. We don't pay attention to what an everyday price will be, even from here and going forward. What we focus on is delivering value for our customers, focusing on the fundamentals that we're focused on, which is experience. The core of experience for businesses matters more than ever now, especially in ever more dynamic markets. We've been through that in the history of this company. Ryan can expand on that as well. But we're quite excited. It's an incredible day.
Does going public help you compete with the likes of Salesforce better? I mean, obviously, Salesforce is getting bigger. Mark Benioff, I've spoken to him many times. He's very colorful and very confident about their ability to compete. How does being public help with that?
I mean, look, I think I think we're going to be, and we are at a size where people are comparing us to those much larger companies, whether it's ServiceNow, whether it's Salesforce and others. But look, we've got to grow into that. And time's interesting, right? I think if you would have told us 3 years ago that we would have been in this spot and this is where the landscape would be, I will tell you one thing: experience is at the forefront of every CEO's mind. Every customers or the experience of their mind, from either employee or the customer side or product. It's the number one challenge that every industry is facing, because let's be honest, we're all operating without a playbook right now. And not having a playbook, Qualtrics adds the data that you need to know where to go. And that's incredibly important.
So speaking of not having a playbook, you've chosen to go public on quite a day with what's happening with GameStop and Robinhood and the controversy around hedge funds and institutional investors. Ryan, what's your take on what's happening here? Are we seeing a fundamental shift in power from institutions to individuals? And is that dangerous, or how do you view that trend?
Well, look, I mean, we chose to go public in 2018 when we were the only show on the road in 2018. We knew that when we were coming into this, filing with an election, post-election, we're in the middle of a pandemic. I mean, look, we built this for 20 years, and we truly want to focus on building a long-term company. I think this shift back to retail or to individuals has been happening for a long time. I don't know how it's going to play out, but I think that this is a trend that's been happening for decades.
There definitely seems to be a pushback against centralization and a pushback against institutions. And Zig, I wonder, there's a concern about individuals losing a lot of money in terms of all of these retail trades. But on the other hand, folks are saying, who is Robinhood to cut them off? Whose side do you take here? Do you have a view on who should have the power?
Look, we're not really getting caught up in the market, and frankly, when you look at some of the market dynamics that are taking place today, I mean, there's just a different set of dynamics that are probably representative dynamics that took place 10, 15 years ago. But if you look at the fundamentals of what we do and what we're focused on, which is experiences, it's becoming the new currency of business. And if you look at tech and how people are trying to get close to become more personal to their customers, more engaged with their employees, what we're finding is that there's a significant market opportunity here. And we think that a lot of investors see the fact that we're building this company for the long run. The culture of this company has been designed to go build something that should be able to affect many generations of organizations that end up leveraging our platform. And that's partly why today is just a milestone of where we're going to be headed with this company.
Yeah, and I'll double click on that. I mean, when it comes to the Robinhood and those apps that are out there, they've created an experience that has let a lot more players or retailers or individuals go and trade. And, I don't think it's that much different than Uber and a DoorDash. And, I think every industry is having to adjust to that. And we're watching that. We've seen it in the hotel and travel and hospitality industry. We've seen it in the food delivery industry. I think it's just coming this way now. And so I don't chalk it up as more than that. I don't know why it's such an alarming thing when did we not see this coming, right? And maybe some of the tactics are under question and that's what it is. But, there's entrepreneurs sitting around the world everywhere trying to disrupt an old experience. And if companies who are playing in that space don't design and improve that, then here we are.
Ryan Smith there, founder of Qualtrics and also owner of the Utah Jazz, as well as Zig Serafin, CEO of Qualtrics. We'll continue to keep our eyes on them. All right, coming up, other trading platforms are pushing back, saying they're not responsible for halting trades on GameStop, AMC, and others. We're talking to M1 founder and CEO Brian Barnes next. We will also bring you more of my interview with the CEO of Robinhood. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Robinhood still getting slammed with criticism over whether they made the right call, limiting trading of certain securities like GameStop and AMC. I spoke with co-founder and CEO Vlad Tenev late yesterday and asked what drove that decision to halt trading and tried to get an explanation for why.
So there's a lot of misinformation out there. In particular, there's people saying that we were forced to do this by market makers we route to or other market participants. And I just want to come out and say that that's categorically false. We weren't directed by a market maker or any other market participant. This was a technical and operational decision that we made because Robinhood, as a brokerage, has financial requirements, including clearinghouse deposits that we have to make to various clearinghouses. Some of these requirements fluctuate based on volatility in the markets, and in this current unprecedented environment, can be substantial. So to protect the firm and protect our customers, we temporarily disabled buying in these securities. And we hope to re-enable buying as soon as tomorrow morning.
So that said, did any of your investors or any other market makers ask you to halt these trades, even if that's not the reason why you did it?
No.
So talk to us then a little bit about why you would allow users to sell but not buy if you're about democratizing finance.
Well, users not allowing to sell is very, very painful would be very painful to customers. Getting out of a position, that you're holding, and not being able to do that is painful. And we stand with our customers. We want to give them the ability and the platform to invest in stocks, buy and sell. So restricting buying, obviously not as painful to customers as restricting all trading in a symbol.
So, question from a viewer here, Vlad. If hedge funds can short 140% of a stock, but retail can't go long because of volatility in free markets, how does that make sense?
Well, I mean, look, it's non-negotiable for us to comply with our financial requirements and our clearinghouse deposits. So we just have to do that. Robinhood has always stood and will continue to stand with the individual investor, their ability to have access to buying and selling stocks. And I've got to say now, I can kind of understand how Clorox and Lysol were feeling at the beginning of the dynamic when there's so much demand for something. So we're doing what we can. We hope to have them enabled tomorrow morning. And, the team's been working incredibly hard day in and day out, even before this, so that we're available to our customers and we operate and run a reliable service for them.
Vlad Tenev, CEO of Robinhood, trading still somewhat restricted on the platform. Buying, especially, though, has opened up a bit. For more on what we've been watching happen before our very eyes and how various platforms have taken action, we're joined now by the founder of M1 Finance, CEO Brian Barnes. Brian, thank you so much for joining us. So, look, even after that interview with Vlad, many people don't understand why Robinhood did this, want them to be more clear. I've never seen so much vitriol in my Twitter feed with folks unhappy with his explanation. You also instituted some sort of trading limits, but were more clear about why. So tell us why you halted some securities and explain the rationale.
Yeah, for sure. So first, thanks for having me. The first thing that I would say is not all of these brokerage platforms are the same. So there's a big difference between the trading platforms and investing platforms out there. And I think M1 is much more geared and purposely built for long-term systematic investing. So M1 is not a day trading platform. You can't even place trades on the platform. It's about designing a custom portfolio, allocating to that custom portfolio, and automating it. And so we have a much more long-term oriented approach to how we do that. Because of that, the trading mentality with GameStop, AMC has been less a core component of our business. Yesterday we did about $75 million of notional trade value. Of that, GameStop was about $3 million. So it was money, but it wasn't core to our business or the like. The unfortunate scenario is due to the market dynamics that existed. There were significant liquidity concerns, risk concerns across different clearing firms, different brokerage firms, specifically as it relates to margin and options that basically shut down the way that clearance and settlement happened. And our clearing firm was wrapped up in that due to exposure with options and margin and the like. And just due to sort of concern of counterparty risk, the ability to meet liquidity needs, they shut off our access to trade certain securities. And as a result, we unfortunately had to do the same for our customer base. It's not a decision that we wanted to make, that we would have made, but the unfortunate scenario is they are our core backend infrastructure provider, and we were also reduced access, much like the retail client was.
So I believe Apex is your clearinghouse. We did reach out to them. They said to us that many brokerages limited trading on their own outside of action that Apex took. Are you one of those firms, or was it only because of what Apex, the restrictions that Apex was putting in place, that you made these calls?
From M1's perspective, it was due to our clearing firm, Apex. That the M1 is also a little bit different, with the long-term investing versus the trading. Our platform doesn't allow for intraday trading. So it's much less about buying at 10 a.m., selling at 10:30, or buying options and doing that. It's about designing a portfolio, allocating to that portfolio systematically. And as a result, we only trade twice a day. We trade in the morning and in the afternoon to allocate the customer's money to the portfolio of their choosing. ultimately, everything went according to plan. And so we didn't miss any transactions. And so at the end of the day, the true impact to our end users was mitigated. That being said, in the middle of the day, it looked like we were going to be unable to trade solely as a rationale that APIX placed on us. And as a result, we informed our client base of that and have suffered the ramifications. And I'd say probably rightfully so. We are the retail consumers' access to the markets, and we unfortunately had to shut them out, much like we were shut out.
Now, M1 has seen a surge in popularity over the last week. Apptopia says you have the third highest percentage gain in downloads week over week, more than Robinhood. Robinhood, do they deserve, in your view, the backlash that they are getting at this point?
I think Robinhood has done things incredibly well and been a big force in the industry and been a true leader. And then they've had big missteps that have been reported on broadly. I think the tough, the Wall Street Bet crew at Reddit, I think had one of the best trades of all time that should go, head to head against the Ackman trade in the COVID time, against George Soros breaking the Bank of England. And they were on the massive winning side of that bet, and the rules of the game were changed as they were winning. So I completely understand the vitriol, the unfairness that I do think when people go to a platform that is promoting trading, option trading, and that ability, there's a reasonable expectation that you can do that in many different market environments. And so I completely understand.
Robinhood seems to be taking an outsized share of the vitriol, because they, have all these other relationships with which some people don't understand. Do you think that's fair, or do you understand the call that Robinhood made?
I think the Robinhood call, any other brokerage call that was done was more or less because they had to. I think they lacked the liquidity for clearing the trades and placing the regulatory capital. And then they were exposed to massive, massive risk associated with these positions. And I think it's primarily due to them incentivizing short-term trading and option trading that, they had a platform that rose to prominence by making trading easier, making options trading easier. And as a result, a lot of people built up massive, massive positions in these things with minimal capital through out of the money calls and puts and the like. And as a result, their exposure blew up to the point where they were not capitalized to handle that book of business. And so, I think that's very different than if we were to take an M1 where we wouldn't have made that decision. We have not promoted option trading. We have not promoted short-term trading. We're very much geared towards long-term systematic ownership and have an investing mindset. It is not a trading mindset. You're not trying to time the market, but really deploy money into the investments and understand in the proportion of what you want for free. With that, I think, we unfortunately did change the game, due to the result of our access being removed. But I think that, it's how the platform has been pitched and how it has been ascended to prominence is really the reason for the vitriol that exists.
So in your view, what do you think needs to be changed about the system? What should a company like Robinhood change, or any of these other market participants? Because Wall Street Bets doesn't seem to be going anywhere, and some of these folks are holding on to their shares just to prove a point, even though they could sell them right now and make a ton of money.
Yeah, it's a new phenomenon. This isn't something that we can relate to something that happened, a year ago or 2 years ago. That being said, I do think when a platform rises to prominence, offering an ability to trade, option trade, and the like, getting access removed when people somewhat need it the most, or when it's going in their favor, it does feel unfair. Our users were hurt far more than M1 was, but we felt the same thing when our access was removed. It's the rules of the game are changed halfway through, and I think if you're encouraging that type of behavior and becoming the outlet for that behavior, you have to be able to support that type of business.
Okay. All right, well, we'll keep our eyes on M1. Thank you so much for joining us, Brian Barnes, M1 Finance founder and CEO. Appreciate your perspective. Okay, coming up, despite Tesla and Apple reporting quarterly revenue, shares of both companies continuing to slide in a broad retreat of global equities. We're going to have a recap of their results next. This is Bloomberg. With all the GameStop drama of the week, it's easy to forget some of the biggest tech names also reported results this week. Apple posting a record in sales, but the outlook a little more uncertain. Meantime, Tesla reporting lower than expected profits despite record revenue. Shares of both companies have been falling since they reported results. Joining us to discuss, Pierre Ferragu, Managing Director at New Street Research. And Pierre, I have to ask if you think the GameStop market action, whatever has been happening the last few days, impacted, or put pressure on Apple and Tesla. Would they have been rallying if so much of the market wasn't focused on those names?
That's a good question, Emily. I think I would say no. I think it's I feel like both Apple and Tesla were at a point in time at which you had like a good near-term rally, and like taking a breather for these two stocks did make sense. And when you look at the reporting from Tesla, you had like a disappointing gross margin, no clear guide for 2021, all these things that are very, very technical. I personally find very boring, but usually create that kind of pullback, and nothing really material. And on Apple, same thing. No Q1 guide. Slightly cautious tone. The street understands well the very strong iPhone 12 cycle we are having at the moment, and that created that record quarter. And I think the stock into that worked relatively well. Management is making sure they don't set expectations in a place that will embarrass them in 3 months from now in today's environment where things are still very uncertain. Bringing together all the supply to do phone and things like that. It's still a difficult environment. And so they're just setting the scene for probably another very strong print when they report their second financial quarter.
But Apple hasn't been giving guidance now for a few quarters, and I wonder why folks aren't used to that. I mean, it could be the long-term thing.
I actually would militate in favor of that. I loved what Tesla did, saying our long-term planning is to grow 50% per annum over time, and sometimes more. And this year, one said we might excess that, and the other one said we might materially excess that exceed that. If you look at my expectation on Tesla, that they can manufacture 1 million cars this year. And if they deliver in terms of execution, like all the supply chain management, if they deliver in terms of like putting the cars out and delivering them to end clients, they can do 1 million cars this year, which would be growing 100% year on year. But why would you guide? What's the point of being specific about guiding for a full year? I think it's a waste of energy for everybody. I am a bit surprised, like you, Emily, that Apple introduced that 3 quarters ago, and the market is still getting a bit visibly uncomfortable with that. Maybe it's because the market thinks it's temporary. It's because of COVID-19. And my recommendation to both Apple and Tesla and everybody else would be stop guiding fully. Guiding the next quarter makes sense. It's useful. And that's something on which, when they report, they have already a few weeks. But guiding like for a year ahead, I think is a waste of energy.
I wouldn't be surprised if it is something longer term. When they stopped reporting iPhone numbers, it's been a couple of years since then. What is Pierre's guide then? Where do you think, we've got just about a minute left, but what is your nutshell outlook on Apple and Tesla for the year?
So for the year specifically, I think Apple is very well positioned. The iPhone 12 cycle is very strong. That's 5G. It's all these affluent customers who are stuck at home. They can't travel. They can't go to the restaurant. They spend a lot of money on that kind of like higher end, consumer electronics they can buy on the internet. The supply chain is constrained, so which means that the pent-up demand is going to spill over. So I'm pretty certain Apple is going to continue to pull out very good quarters. And then once that big cycle comes through and the pent-up demand is absorbed, we have to see what happens next. On Tesla, as I told you, they have capacity already for 1 million cars. They're going to get as close as that as their supply chain can let them do. So there is a bit of uncertainty, but to me, the bull case on Tesla is 1 million car and 100% volume growth in 2021. So for both companies, I think 2021 can play out very strongly. And that explains where the stocks are today, even after that small pullback of a few days.
Pierre? We'll have to leave it there, Pierre, but I appreciate hearing your outlook always. Pierre Ferragu of New Street Research, thanks so much for joining us. Okay, still ahead, money can't buy everything, even when it's Amazon and Jeff Bezos. We'll have that story next. This is Bloomberg. Some breaking news. Interactive Brokers has lifted all curbs on options trading. Interactive Brokers like Robinhood put some restrictions in place yesterday. The company tweeting that all of those curbs have now been lifted. Robinhood has also lifted some restrictions, but there are still some restrictions in place. The last time I checked, you could buy only one share of GameStop on Robinhood. I want to bring in Jason Scherer, who covers gaming for Bloomberg and has covered the gaming industry for decades. Jason, I'm so curious for your take on this because many of the folks you cover are also part of this retail trading frenzy. And I'm wondering if you can take us into some of these chat rooms, take us into the mind of some of these traders who could sell now if they wanted, but at this point, in principle, want to prove a point. What do you think is happening here?
Hey, Emily, thanks so much for having me. So it's pretty fascinating. Obviously, this is the biggest story in the world right now, and I've been watching with kind of bated breath as all of this is going down. I think kind of coming at this from a video game fan's perspective, something that's really interesting is that a lot of these people are not big fans of GameStop. I saw some chatter earlier this week about how from some investor-minded folks saying, oh, they're just nostalgic for their favorite store. But no, I mean, gamers hate GameStop. GameStop is known for kind of pushing pre-orders on you and mistreating its staff and selling again and buying your games back at low prices. So I think that's part of what's kind of going on in people's heads right now. And one of the reasons that they're able to like turn it into such a meme and stick with it even when it seems like they should be selling is because they kind of see this all as a joke, as like a practical joke on GameStop.
It is absolutely fascinating. GameStop at this moment, a $22.5 billion company. Meantime, you've been reporting on Amazon's gaming efforts and the lack of success there, despite the amount of resources and money that Amazon has. Why hasn't Amazon's gaming properties taken off?
Yeah, I think what's interesting about Amazon is even though they have all the money in the world, they decided to approach video games the Amazon way, which is to say, take Amazon culture and say, you know what, we're going to throw an Amazon executive at this, and we're going to say, we're going to dominate the video game industry this way. And with games, you can't really do that. Game development is a very emotion-driven industry. People in games talk about finding the fun. That's a common phrase you'll hear from game developers, because a lot of fun making a game good is just sitting down and experimenting with it and innovating and iterating. And what Amazon did was they tried to take their Amazon principles, which are very much about metrics and writing 6-page reports about everything and having the numbers in front of you, and try to apply that to making games, and it just did not work. The person they hired in charge, and our story is mostly about this, is a guy named Mike Frazini, who was an Amazon lifer and had never made a game before. And what happened was, according to our sources and our reporting, he surrounded himself with people who did know games and then just didn't listen to them, which I think is kind of a tale as old as time.
Well, we've saw Amazon get out of the health business that they were trying to start. But is this something that you expect Amazon to double down on? They're not going anywhere, giving up on it just yet?
Yeah, it is. Our reporting suggests that they've been spending many, many millions of dollars, almost $500 million a year on this initiative. And I don't see that stopping anytime soon, even though they've had some false starts. I think Jeff Bezos, CEO of Amazon, of course, views gaming in a very bullish light, and I think he really wants to have games be part of their whole ecosystem, the way that they've had some false starts with their TV initiative and then eventually got it running and got some good stuff in there. I think he sees a similar path forward for the video games division.
All right. Bloomberg's Jason Scherer, thanks so much for your reporting and the color you brought to us for some of the folks in the gaming industry and how they might be watching GameStop today. Bloomberg's Jason Scherer joining us there. That does it for this edition of Bloomberg Technology. Wow, what a week. Have a wonderful weekend, everyone. I'm Emily Chang in San Francisco. We'll see you next week. This is Bloomberg.